is going to deal with another concept. Oh, I thought we had variance analysis. Sorry, cost, volume, profit. So what we're going to look at here, we're going to talk about something called the relevant range. There are oftentimes costs that, as long as they fall within a specific relevant range, well, we'll talk about exactly what that means. And then from there, we're going to look at a method out there called the high-low method, and then we'll come up with a cost, volume, profit, income statement, look at the break-even. So the first objective here that we are going to come up with, cost behavior analysis, is the study of how specific costs respond to changes in the level of business activity. So we know that any time there is business activity, there will be some costs at some level that do remain constant or fixed. There will be some costs that are variable in nature. And then sometimes there's what we call mixed cost, a combination of both. Some costs change, others remain the same. This analysis that people are hired to do provides management with an understanding of how to conduct their operations and possibly decide which products to manufacture more of or less of or cease altogether. And the key here in looking at this type of analysis is really measuring which activities are providing us with certain profits and which maybe are limited with their profits. Activity levels can be expressed in various concepts. One is in sales dollars, which would be a retail company, how much was sold. In a trucking company, how many miles were driven for the year. In room occupancy would be the activity level for hotels. What is the percent of fill rate for hotels? And number of dance classes taught may be a dance studio. Or in that case, it could be the number of individuals taking the classes as a whole. So that makes sense to us, doesn't it? Target, they care about their gross sales. Trucking companies, for the most part, when they look at the form of, in terms of activity, how many miles, because they get paid per mile on the road. Room occupancy, if the occupancy rate is sitting at 50% or below, well, their activity is an issue, and they may need to revise their manner in which they're pricing their product. Okay, so changes in the level or volume of activity should be correlated with changes in costs. Activity level selected is called the activity index or the volume index. Now, an activity index is going to identify the activity that causes the changes in the behavior of the costs. It allows costs to be classified as variable costs, fixed cost, or mixed cost. Let's just take, for example, a hotel room. A hotel room, there are going to be certain items that are going to be fixed no matter what. At some level, the depreciation on the entire building is going to be fixed if hotel rooms are used or not, right? At some level, certain people in management are going to be fixed no matter what. But what would a variable cost be? Could be the utilities. A little bit. That's going to be more of a mixed cost because there's going to be a certain amount of utilities you're going to have if the rooms are rented or not. But cleaning costs, wouldn't that be variable? Right? Each room that's being occupied is going to need to be cleaned. Cost, variable cost. Variable costs are going to be costs that vary in total directly and proportionately with changes in the activity level. If the activity level increases 10%, then the variable costs are going to increase 10%. If activity level decreases 25%, then the variable costs would decrease by 25%. Variable costs remain the same per unit at every level of activity. A room. The cost to clean a room, for the most part, is going to be 40 minutes for the cleaning help. So if one room is being occupied, it's probably going to be 40 minutes for that one room. Changing the sheets, do you get what I'm trying to get at? Damon Company manufactures tablet computers that contain a $10 camera. The activity index is the number of tablets produced. As Damon manufactures each tablet, the total cost of the cameras used increases by $10. As Part A of illustration 5.1 shows here, the total cost of the cameras will be $20,000 if Damon produces 2,000 tablets, and $100,000 when it produces 10,000 tablets. So this line is just going to continue to go up. Okay, the unit price is the same, but based on volume, the cost as a whole per that product is going to increase along with it. We see that a variable cost remains the same per unit as the level of activity changes. Now, here's one. Damon Company manufactures tablet computers that contain a camera of $10. The activity index in the number of tablets produced is the number of tablets produced. As Damon manufactures each tablet, the total cost of the cameras used increases by $10. As Part B of this illustration shows, the unit cost of $10 for the camera is the same if Damon produces 2,000 tablets or if Damon produces 10,000 tablets. The cost per unit does not alter. Okay? So, here is the number of tablet computers produced. Okay? As it increases, the total cost is going to increase. Per unit, these are total costs, the cost per unit stays the same. Fixed cost. Costs that remain the same in total, regardless of changes in the activity level within a relevant range. Why within a relevant range? Let's think of this. Ford Motor Company used to produce trucks out here. Well, that factory is going to cost the building the same amount if they produce 5 cars a day or if they produce 20 cars a day. Now, we know it's only so big, they might not be able to produce 300 cars a day. Do you see what the relevant range means? Okay, there is still a limit on everything. This room, we've got depreciation for this room if there's 5 students or 40 students. Now, it's just impossible to fit 200 students in. Okay, so a relevant range. If there's 200 students, what happens? You're going to knock out this wall. Okay? Maybe a couple walls. So it's going to change just because when we're dealing with a relevant range, we're dealing with 1 to 30 students. Make sense? You guys get it. Okay, so fixed cost examples include property taxes, insurance, rent, and depreciation. Damon leases its productive facilities at a cost of $10,000 per month. Total fixed cost of the facility will remain constant at every level of activity. So it doesn't matter if Damon produces 1,000 tablets or 20,000 tablets. The rent is going to be $10,000 a month. Okay? Fixed costs. Fixed cost per unit cost varies inversely with activity. Now hang in there with me. As volume increases, the unit cost declines. Property taxes, insurance, rent, and depreciation. So if we're dealing with a Ford truck motor company and there are 100 trucks produced per month, if the rent is $30,000 on the factory and we have 100 trucks, that unit cost of the rent per truck is, guys, sorry, my mind, 300 bucks? 30 bucks? Let's say 30 bucks. Yeah, 30 bucks. 300 bucks. But if we produce 500 trucks, do you see how the unit cost goes down? So when we're dealing with, here's an example. Damon leases its productive facilities at a cost of $10,000 per month. Total fixed cost of the facility will remain constant at every level of activity. But on a per unit basis, the cost of rent will decline as activity increases. As Part B of the illustration shows, at 2,000 units, the unit cost per tablet is $5. 10,000 divided by 2,000. $10,000 in rent divided by 2,000 tablets. When Damon produces 10,000 tablets, the unit cost of the rent is only $1 per tablet. So it's going to cost us less to produce those tablets when we're producing 10,000 for the purpose of the facility. So you see here, the total cost is going to remain constant no matter how many items are produced, but the fixed cost per unit now become variable. Or I should say go down. Variable costs are costs that A, vary in total directly and proportionately with changes in the activity level, B, remain the same per unit at every activity level, C, neither, or D, both. Both. Okay. Relevant range. Throughout the range of possible levels of activity, a straight line relationship usually does not exist for either variable or fixed costs. Relationship between variable costs and changes in activity levels are often curvilinear. For fixed costs, the relationship is nonlinear. Some fixed costs will not change over the entire range of activities, while others may change. Okay. So when we're dealing with variable costs, the curvilinear is affected within the relevant range for variable costs. For total fixed costs, it's nonlinear. A relevant range is basically the range over which the company plans to operate. That's what we care about. Now, mixed costs are a combination of a variable piece and a fixed piece. So, Helena Company reports the following total costs at 2 levels of production. So we've got Helena producing at 10,000 units, and then an analysis of them producing at 20,000 units. We need to classify, are these costs variable, fixed, or mixed? So, direct materials are going to be $2 per unit, right? $2 per unit if it's 10,000, $2 per unit if it's 20, but the total overall costs are variable related to the quantity. Maintenance, what do you guys think? Does it look like it's fixed, variable, or mixed? It's going to be mixed. Then you see the direct labor. When you're producing 10,000 units, it's $1.70 a unit, and it is still $1.70 a unit at 20,000 units. Indirect is the same. But look at depreciation, guys, and look at rent. It doesn't matter if we're producing 10,000 units or 20. The cost, the total cost is the same. So it's important that I want you to know how you can classify if something's a fixed cost, a variable cost, or a mixed cost. Okay? Let's take a minute and go to the book. Exercise 5.1. So, Bonita Company manufactures a single product. Annual production costs incurred in the manufacturing process are shown below for two levels of production, 5,000 units and 10,000 units. We know what the terms variable, fixed, and mixed are because you will know those terms because you're going to get some multiple choice on those. Let's classify the costs as variable, fixed, or mixed. Okay? So, what do you think? Direct materials, variable. Direct labor, variable. Utilities, mixed. Rent, fixed. Maintenance, mixed. Supervisory salaries. Awesome. Okay, let's go back here. Using now the high-low method. This uses the total costs incurred at the high level of activity within the relevant range and the low level of activity. The difference in cost between the high and low levels represent variable costs, since only the variable cost element can change as activity levels change. So how we're going to figure this is we will determine the variable cost per unit using change in total cost divided by the high minus the low level. We come up with a variable cost. So you see here, we've got Metro Transit. They have the maintenance costs and mileage for a 6-month period. January, February, March, April, May, and June. We are going to take the low month, we're going to take the high month, and we're going to compare them. So we've got $63,000 in costs, the high month, the low month, $30,000 in costs. Okay? The difference is $33,000. We're going to take the 50,000 miles driven, the low month, 20,000 miles driven, gives us 30,000 mile difference. The $1.10 cost per unit is the difference when we go high versus low, how we'll calculate the variable piece. Determine the fixed cost by subtracting the total variable cost at either the high or the low activity level from the total cost of that activity. So, in this scenario, going back here, you see this is 63,000 miles. We take the 63,000, our variable cost, 50,000 at $1.10, which we came here, shows our fixed costs are going to be 8,000. At the low, we've got our low cost of 30,000. If we take our 20,000 miles at $1.10, we've got the 22,000 here. The difference between each one, 8,000, they consider to be the fixed cost on that maintenance. Okay? So the fixed amount, no matter if they're traveling 20,000 miles or 50, is 8,000. Maintenance costs are therefore 8,000 per month of fixed costs plus a $1.10 per mile variable cost. So the maintenance cost, 8,000 times 110 of miles driven. So at 45,000 miles, the maintenance costs are going to be 57,500. Okay? Mixed costs consist of a variable cost element and a fixed cost element. Fixed cost element and a controllable cost. Relevant and controllable. We know it's a variable and a fixed. So, let's do this one. Bynes Company accumulates the following data concerning a mixed cost using units produced at activity levels. So, we are seeing here the highest unit was 9,800 units produced for a total cost of $14,740. The lowest month was May, 7,000 units at $11,100. So we need to estimate what the variable cost is and what the fixed cost is. So we're going to take our high amount and our low amount. Okay? The high cost is $14,740. The low cost is $11,100. So the variable and fixed, we take the $14,740 minus our $11,100 because that's the high month. We then take the low month, 7,000 units and 9,800 units, 7,000 units. We come up with $1.30 per unit. Okay? Our fixed costs are going to be the $14,740 minus the $12,740 because we're taking $1.30 per unit right here, and we're taking the cost here of $14,740. We're taking the $1.30 per unit, the 9,800 times $1.30, and the difference, the $14,740 minus the $12,740, which we got from taking this variable cost here, is the fixed cost of $2,000. Okay? Now it wants us to know, estimate the total cost if the company produces 8,000 units. I want you to take a minute and see what you can come up with there. I'm going to turn off this. If we expect the company to produce 8,000 units, we're going to take the fixed amount of 2,000. We'll add to it $1.30 times 8,000 units to come up with our costs of $12,400. This is the high-low method. Now what we're going to do is we're going to go to another problem. We are moving right along. Let's look at the exercise 5.5. Okay? We're going to do something just like this. The Controller of Hall Industries has collected the following monthly expense data for use in analyzing the cost behavior of maintenance. Determine the fixed and variable cost components using the high-low method. Then we're going to prepare a graph showing the behavior of maintenance costs. And well, we're not going to do that one. We're just doing A. So what is the high month? June. Total maintenance cost of $46.20. Total machine hours, 8,000. What's our low month? January. Total maintenance cost of $26.40 and total machine hours of 3,500, right? So, let's go in here. And come up with our maintenance costs. So we've got, what was the high amount, the high cost in June? $4,620. The low month? $2,640. We're going to then divide this by the high month of units or hours. 8,000 minus 3,500. So what do we have here? 4620 minus 2640 gives us what? 1980. We're going to divide that by 4,500. 1980 divided by 4,500. 44 cents. Variable hour. So we know our variable cost there is going to be 44 cents, how we calculate it. So now I'm going to show activity level. We've got high, we've got low. We've got our total cost. The high month was $46.20, wasn't it? Right? The low month was $26.40. Right? Then, if we take in less variable costs, the high month was what? How many? 8,000 hours at 44 cents gives us how much? $35.20. Then we've got the low month of 3,500 hours at 44 cents gives us $15.40. So our total fixed costs are going to be the difference here between our total cost minus our variable cost, 1,100. We should be able to do it the same way here. 1,100. So our total fixed costs are 1,100. The variable component, 44 cents a piece. Okay? Let's look at E6, 5-6. PCB Corporation manufactures a single product. Monthly production costs incurred in its manufacturing process are shown below for the production of 3,000 units. The utilities and maintenance costs are mixed costs. The fixed portions of these costs are $300 and $200 respectively. So we see here production in units of 3,000. Our production costs are direct materials, direct labor, utilities, property taxes, indirect labor, supervisory salaries, maintenance, and depreciation. Now they're telling us that the utilities and maintenance costs are mixed. We know that, okay? So A tells us which costs are variable, fixed, or mixed. Well, the mixed we know are utilities and, oh boy, isn't that easy? How about the variable, guys? Direct materials, direct labor, what else? Indirect labor. The others are going to be fixed, aren't they? Now we're required to calculate the expected costs when production is 5,000 units. How are we going to do this? Well, let me see here. Okay, so what would I'm just going to put this up. Our production units 3,000 and the various costs, so we're going to have to figure out the costs per some of the variable costs here. So, fixed costs. What are our fixed costs going to be? Here, let me. Calculate the expected cost when production is 5,000 units. So the first thing let's do is come up with the fixed costs are going to be what? Fixed costs. Taxes are how much? 1,000. What else? 1,900. What else? 2,400. What else? The fixed portion of these mixed costs up here are 300 and 200. Okay, so I'm going to add that up there. So we've got how much? 5,800. Okay, those are our fixed. Now we need to determine the variable costs that it was to produce 3,000 units. What are our variable costs? The direct materials, the direct labor, and the indirect labor. So the variable costs, can you guys help me? What is the direct materials? 7,500. The direct labor, 18,000. And the indirect labor equals what? 22,500, 29,000? No, that's 30,000, right? 75, 18. It's 25,500, 45. So 30,000 divided by 3,000 units is what? $10 per unit, isn't it? Right? 7,500 plus 18,000 is 25,500 plus 4,500 is 30,000. We take all those total costs divided by 3,000 units. I got the 3,000 units over here. 3,000 units. That gave us $10 per unit. Okay? The next one, the variable cost portion of mix cost. So we had two items that were mixed. So the mix cost basically this is going to be total cost minus the fixed portion. Okay? So our utilities cost how much? $2,100. And what was the fixed portion they told us? $300. So the remaining is what? $1,800 divided by 3,000 units is what? $0.60 per unit. Okay? So now our maintenance. The total cost is what? $1,100 minus the fixed portion is what? $200, means the variable cost is $900 divided by 3,000 units equals what? 30 cents per unit. Right? So it asks us, guys, calculate the expected cost when production is 5,000 units. Okay? So how are we going to do that? What are our variable costs? 90 cents, right? 90 cents times 5,000 is what? Gives us what? $4,500. And then what are our $10 variable costs times 5,000 is what? 50,000. And our fixed costs are what? We should have it up here somewhere. 1,800? 5,800? See how we're calculating the total cost there? Make sense? I should have. I meant to. So, we've captured two really important pieces. Now we've got the third. CVP, Cost Volume Profit Analysis. This is basically looking at costs and really understanding how those costs change based on volumes. Okay? It is a manager's tool for making decisions. They use it in setting prices and determining production mixes and using the facilities to their fullest. So when we deal with CVP, we're dealing with the volume of activity or the level, the selling prices. We need to know the variable costs and the fixed costs to come up with what we call a sales mix. Now we're going to assume things. Assumptions. Behavior of both costs and revenues is linear throughout the relevant range. Costs can be classified accurately as either variable or fixed. Changes in activity are the only factors that affect cost. All units produced are sold, and when more than one type of product is sold, the sales mix will remain constant. Okay, guys, these are a lot of assumptions. You know they call what assumptions are? Assumptions make an ass out of you. And now, kind of applies, but this is such a simplistic way of looking at how companies view cost. You know and I know it's not so black and white, but for the purpose in this class right now, we're going to make it very black and white, okay? So these are the assumptions we are going to use in this class. Which of the following is not involved in CVP analysis? I know it. Do you guys know it? Okay, I'll put this back. Fixed cost per unit. Okay? It's got total fixed costs, but we don't care about per unit. Okay. CVP income statement. We only use, most of managerial accounting is for internal use only. It's not going to external users. I hope that's one thing you really understand with managerial accounting. It's for internal users only. It classifies costs and expenses as fixed or variable. And this is the key. It reports a contribution margin in the financial statement. The amount of revenue remaining after deducting variable costs. And basically what that does is allows us to know how much can go towards contribution margin, is to see after we subtract those variable costs, how much is available for fixed costs. Here you see it. Vargo Video produces a high-definition digital camcorder. Relevant data for the camcorders sold are unit selling price, variable costs, monthly fixed costs, and our number of units sold. So the CVP is going to show our sales. 1,600 camcorders times the selling price of $500, $800,000. The variable cost, 1,600 camcorders times $300, $480. This gives us our contribution margin of $320. Then, from that, we subtract our fixed costs to see what our net income is. There's a reason for this crazy formula, and you'll see it in a minute. The contribution margin is available to cover fixed costs and to contribute to income. The formula for the margin and the computation is the selling price minus the variable cost, which means each unit contributes $200 towards fixed cost and income. Okay? Now, if we assume zero net income, we determine how many units do we need to produce or sell to get zero net income. We need to sell 1,000 units just to break even. Okay? So we need 1,000 units to cover our fixed cost of $200,000 because our contribution margin's $200 per unit. But now it asks, what happens if we sell not just 1,000 units, but 1,001 units? Well, then that contribution margin is pure income on that one extra unit. So what we're trying to do is figure out what our sales volume is in order to just not only break even, but achieve a certain level of income. The contribution margin ratio is going to show the percentage of each sales dollar that gets applied towards either fixed costs or profits. The formula is we take our contribution margin, which if we go back here, remember it's $200 per unit, okay? Our $200 divided by our selling price gives us our ratio. It's $200 of our $500 price to give us our 40% goes towards fixed cost and profit margin. So if we sell 1,001 camcorders and our variable costs are $300,300, then as you see here, we're still going to come up with the same. If sales are 100%, variable costs are 60%, our contribution margin is still the same, 40%. This shows us an income statement. CVP income statement based on the margin ratio. So if we just break even, then we've got sales of 500,000. We've got the per unit, which is not going to change because it's variable, and we show net income of 0. Then Vargo wants to know what would happen if we increased our sales 200 units. Then we show here with the change 600,000 would be our sales. The variable cost is going to be 60% of the sales price. The contribution margin is going to be 40% of the sales price. When we subtract out our fixed cost, it allows us to see what our net income is. Contribution margin is revenue remaining after deducting variable costs. May be expressed as contribution margin per unit. Is selling price less cost of goods sold, or D, both A and B above? Yes, A and B above. So if we look at this example, Ampco Industries produces and sells a cell phone, operated thermostat. Information, ooh, that'd be cool to have, wouldn't it? I know, but I don't have one. Information regarding the costs and sales of thermostats during 2017 are provided below. The unit selling price of a thermostat is $85. The variable costs are $32. Guys, just right there, what is going to be the contribution margin per unit? $53. That is the contribution margin per unit. Then it tells us our monthly fixed costs and our number of units sold. Our job is to prepare a CVP income statement for Ampco Industries for the month of September. So, here we go. The sales at how many units? I'm sorry, I forgot. 4,000 units. So, 4,000 units at 85, 340,000. Our variable costs, 4,000 units at 32, gives us our contribution margin, $53 times 4,000 units is going to give us 212,000. We subtract our fixed costs, and look what we get. Whoops, our net income of 22,000. Let's do a problem. Let's do in E12. That's 512. In 2016, Manoff Company, I'm not going to, no, that I need to move on to the next one. Let me see here. You know what, I'm just going to go, I'm going to continue on so I don't, excuse me, we're just going to continue on. Let's look at break-even analysis, then we'll do a bunch of problems afterwards. So our job here in coming up with this crazy CVP analysis is to ultimately come up with a break-even. A break-even where our sales equal 0. We've covered our costs, there's no net income. Process of finding the break-even point level of activity at which total revenues equal total costs. We can figure this out based on that contribution margin we were doing. Remember in that last problem we said the contribution margin is $53 per unit? If our total fixed costs are $190,000, we could figure out how many items we need to sell by $190,000 divided by 53 units. Okay? So we're going to understand how we come up with a break-even analysis. Break-even occurs where total sales equal variable costs plus fixed costs. Ultimately, net income equals 0. Now, guys, no company's going to live on breaking even. This is just the beginning. We want to make money or you will not be in business. But the break even just allows us to see what we need to just break even. So as you see here, we show required sales of $500 per unit minus the variable cost of $300 per unit minus our total fixed cost of $200,000 comes up with a 0 net income. So by doing a little algebraic equation here, we bring the 300 units over to 200 quantity equals 200,000 in fixed costs. Divide it, which means the number of quantity that we need to sell is 1,000 units to break even. This is where the selling price we know of 500 units and the variable cost of 300 units with our fixed cost of 200,000. You can see right now by looking at this how beneficial this is to say, well, what happens if we increase the sales price $5? Okay? How does that alter the equation? Contribution margin technique. Contribution margin equals total revenues minus the variable costs. We can use that break-even point by computing the margin per unit or the ratio. So, if our fixed costs are 200,000 and our contribution margin per unit is 200, we know we need 1,000 units. Or, we say our fixed costs are 200,000, divide that by our contribution ratio of 40% to know how much we need to show in sales to break even. Okay, so let's look at this one. Goss & Company is planning to sell 200,000 pliers for $4 per unit. The contribution margin ratio is 25%, which also means $1. Which means variable costs are how much? $3. Right? If Goss & will break even at this level of sales, what are the fixed costs? Selling 200,000 units at $1 is the contribution margin. What do we know the fixed costs have to be? 200,000. Right on. So, here's how we can utilize this analysis. Lombardi has a unit selling price of $400, variable cost per unit of $240, and fixed cost of $180. Compute the break-even point using a mathematical equation and the contribution margin per unit. So let's just look at the mathematical equation. If we're selling it for $400, variable costs are $240, what's our contribution margin? $160? What's $160 divided by 400? What? 400, the sales price? 40%. So basically, our 400 minus our variable costs minus our fixed is going to be net income of 0. Our 160 is our contribution margin per unit. Minus the fixed cost of 180 means we need to sell 1,125 units to break even. Okay? Now, by using the 40% route, if our fixed costs are 180, divide that by 40%. What am I doing wrong? Well, by contribution margin 1125, I think I'm trying to come up with the total number of sales. If we do our fixed cost of 180 divided by 40%, it'll tell us how much we need to sell totally. Okay. So basically, we learn from this CVP analysis that we may have to vary sales to come up with a specific income, be it quantity or price. So we can show that if we have required sales of $500 a unit and we have variable costs of $300, then we can figure out what we need, and if we also know we want to make $120,000. If we know we want to make $120,000, then we take our fixed cost and our targeted net income, combine them, divide that by our contribution margin to determine the quantity that we need to sell in order to make that amount of money. So this is going above and beyond the break-even. This is determining not just our break-even, but we want to make $120,000. How much do we need to sell? So, to determine the required sales in units, we take our 320, divide it by 40%, contribution margin ratio, and it lets us know how many dollars we need to sell. As you see here, if Vargo sells 1,400 camcorders, it shows at 1,400 units intersects with the sales line. 1,400 units intersects with the sales line. The difference between the two amounts equals the profit of 80,000. So here is the break even. We need to make 1,000 units just to break even. Then, as we increase the units, this is where we've got the break even in units. At 1,400, we've got a profit here. Okay? So the line at 1,400 intersects the sales line at 700,000 and the total cost line of 620,000. See, so the sales here is 7. Here are the cost of 620. This difference here is going to be our profit of 80,000. The difference between the two amounts equal the profit. Okay. Now, with every job or with every company, in a perfect world, we cover our fixed costs, we know what our net income is, voila, that's what we want to sell. But what we call the difference between the actual sales and the sales at the break-even point is our cushion called a margin of safety. So that margin of safety is what we want to make minus what we need to make just to break even. That difference is the sales price, is the margin of safety. This is not our net income. This is the sales price of the difference. We can take our margin of safety, 250, divided by our sales to give us our margin of safety ratio also. Okay. So right now, let's look at E58. All That Blooms provides environmentally friendly lawn services for homeowners. Its operating costs are as follows. Depreciation, $1,400 a month. Advertising, $200 a month. Insurance, $2,000 per month. Weed and feed, $12 per lawn. What is that going to be? Variable. Direct labor, $10 per lawn. Fuel, $2 per lawn. All That Bloom charges $60 per treatment for the average single-family lawn. Determine the company's break-even point in number of lawns serviced per month and dollars. Okay? So what we're going to do is they charge $60 a month. $60 per month is the sales price. What are the variable costs? $12 plus 2. 12 plus 10 plus 2 is $24, right? So $60 minus $24 of variable costs equal $36. Our contribution margin per lawn is $36. So if we go here, let's take the contribution margin per lawn. $60 minus the 10 plus the 12 plus the 2. Equals what? $36 per lawn. Okay? So our contribution margin ratio, how are we going to figure that out? Will we take 36 bucks divided by 60 bucks? What's that going to be? What's half of 60? 30. So that's 50%, right? And then we got an extra 6. What is 6 of 60? 10%. So 50 plus 10 is what? Good. Guys, I used to do that before calculators. Guess what happened when we got calculators? How many of you remember phone numbers anymore? You don't have to. You just say call home. Same thing. 60%. I'm not beating y'all up. It's amazing how we don't have to think. Okay. So our contribution margin ratio is 60%. What are our fixed costs? $1,400 plus 200 equals what? 3,600. So our break even in the number of lawns we need to do, how are we going to figure that out? $3,600 in fixed costs. Divide that by 36 bucks a lawn is our contribution margin. How many lawns do we need to do? 100 lawns to break even, right? What would be our break even in dollars of sales? 100 lawns times how much do we charge per lawn? 100 times 60 is 6,000. Or what we could do is take our $3,600 of fixed costs, divide that by 60%, our contribution margin. 36 divided by 6% is what? Should be 6,000. Okay? Make sense? Yes, no. E59. The Palmer Acres Inn is trying to determine its break-even point during its off-peak season. The room is 50 rooms, that it rents at 60 bucks a night. Operating costs are as follows. Salaries, $5,900 per month. Fixed or mixed, or fixed or variable? Fixed. Utilities, $1,100 per month. Fixed. Depreciation, $1,000 per month. Maintenance, $100 per month. Maid service, $14 per room. Variable. Other costs, $28 per room. Determine the inn's break-even point in the number of rented rooms per month and dollars. We're going to use this exact same chart. Okay, so how much does it sell for a night? 60. And what are our fixed costs per room? 14 plus the 28, right? So what's our contribution margin per room? 60 minus 42 equals 18 bucks. So our ratio is going to be $18 divided by 60. What is our ratio margin? 18 divided by 60 is 30%. What are our fixed costs, guys? I'm sorry. 5,900. 1,100 plus. Okay. And 100. Equal how much? 59, 7, 8, 8,100? 8,100, right? Break even in number of rooms. So, how are we going to figure this? $8,100 divided by 18 means what? 450 rooms. How about in dollar sales? What are we going to do there? 100 or 450 rooms times $60 a room gives us what? Right? Or we can do it another way. Can't we take the 8,100 divided by our contribution ratio? 81 divided by 30% would still give us 27,000. Right? Okay, let's look at exercise 513. Unless you want to do another one here. You guys tell me. Let's do 511. 511 says, Spencer Cars provide shuttle service between 4 hotels near a medical center and an international airport. Spencer Cars uses 2 10-passenger vans to offer 12 round trips per day. A recent month's activity in the form of a cost, volume, profit, income statement is shown below. So they show fare revenues at 1,500 fares, 36,000, and the variable costs, the fuel, the tolls, and the maintenance, gives us our contribution margin. Then our salaries, depreciation, and insurance gives us our net income. And they want us to figure out what the break-even point is. Okay? How are we going to do that? What's the fare revenue? $36,000 divided by how many fares? I'm sorry, what? 1,500. How would we figure out what that is per fare? What's the cost they charge per fare? 24 per fare, right? So our 24 per fare, if we look at our our 9,000 of variable costs, 9,000 divide that by 1,500 fares gives us how much in variable costs per fare? $6. So 24 minus how much is the variable cost? Did we say $6? What does that make the contribution margin? $18 for each fare, right? What are our fixed costs? $18,000. $18,000 in costs divided, what's our contribution margin per fair? 18. How many of those fairs do we need to have in a year, in a month, to break even? 1,000 fairs, right? How can we calculate it in terms of sales? 1,000 fairs at how much per fair ride? 24 would give us how much? Make sense? Good, guys. Okay. What did I tell you we were going to do? 13, right? 13. Billings Company had the following information available for September of 2017. Unit selling price of video game consoles, unit variable costs, total fixed cost, and the number of units sold. Compute the unit contribution margin. Okay, guys? The selling price is how much? 400. The variable costs are 280. What would that make our contribution margin? 120, right? The 120 is our contribution margin. What are our fixed costs? 54,000. How many units would we need to sell to break even? 54,000 minus 1 divided by 120 is what? 450 to break even, right? Make sense, guys? So let me clean this up and we'll go through it. So the first thing that they want us to do is create a CVP income statement. Billings Company and CVP okay? Okay. Our sales, 600 video games, consoles, sales price is what? 600 times 400 per unit is a total of what? Okay. What are the variable costs? How much per unit? 280. So 600 video game consoles times 280 per unit is I'm sorry, 168. Contribution margin is 72,000. And over here, 120 per unit, right? What are the fixed costs? 54,000. So our net income is what? 18,000? 72 minus 54? 18, right? Now, compute the number of units sold, we know. Compute the number of units that have to be sold in 2017 to reach the stockholders' required profit level, which we did. Assume, excuse me, wrong. I'm on the wrong one. Even. God. Units and units. Compute billings, break-even point, we did, the 450. Now we are going to prepare our CV income statement for the break-even point that shows both total and per unit amounts. Okay? So, we know the break-even is 450. So we're going to use the same format to calculate based on 450 units. Okay? So, if we do this for 450, 450 game consoles, how much is our total cost? Again, I didn't need to get rid of that. This is not changing. That remains constant. So our 450 games times 400 is our variable cost, 280 per unit times 450 units, 126, which means our contribution margin is 54,000. What are our fixed costs? Okay? You guys good? Okay, let's take a break.